Welcome back. Today we're diving into one of the most dangerous traps in life insurance planning, one that catches even sophisticated investors off guard. A $500,000 life insurance death benefit looks secure on paper. Your policy is paid up, your coverage is solid, and you're sleeping well at night. But then your insurance agent mentions a 1035 exchange. It sounds simple. Swap your old policy for a new one with better features, and there's no tax consequence. Tax-free, clean, simple. Here's the problem. Your insurance agent's oversimplification just set you up for a six-figure tax disaster. The IRS has published specific, technical rules about what qualifies as a legitimate 1035 exchange. These aren't suggestions. They're compliance requirements with teeth. Miss just one detail, and I mean one, and that $500,000 policy could generate $55,000 to $111,000 in unexpected tax liability. For some high-net-worth individuals we've worked with, the number has climbed higher. In the next 9 minutes, I'm going to walk you through the 3 compliance rules the IRS actually enforces. I'll show you real-world case studies of what happens when people get this wrong, and I'll give you the exact framework to protect yourself before you sign anything. ***, the foundational problem. What is a 1035 exchange? ***, first, let's clarify what a 1035 exchange actually is. The name comes from Section 1035 of the Internal Revenue Code, passed decades ago to provide tax-deferred exchanges between insurance products. The intent was reasonable. If you wanted to upgrade your life insurance policy without triggering a taxable event, the government would allow it. But here's what most people don't understand. A 1035 exchange isn't automatically tax-free just because it involves insurance. The IRS doesn't care what your agent told you. The IRS only cares whether your specific transaction meets their exact requirements. According to the National Association of Insurance Commissioners, NAIC, an estimated 2 million life insurance policies are exchanged annually in the United States. Of those, industry insiders estimate that 15–25% contain technical violations that could trigger tax exposure. That's 300,000 to 500,000 policies per year that are sitting in violation without the policyholders knowing it. ***, Rule #1. The insured person must be the same ***. Let's start with what seems obvious, but trips up more people than you'd think. When you do a 1035 exchange, the person whose life is insured on the old policy must be the same person insured on the new policy. You cannot exchange a policy insuring your life for a policy insuring your spouse's life. You cannot exchange a policy on yourself for a policy on your business partner. Same insured, no exceptions. This sounds straightforward until you layer in real-world complexity. ***, case study, the partnership policy problem. ***. Consider David and Mark, 2 equal partners in an engineering firm worth $8 million. They had a buy-sell agreement funded with life insurance. David owned the policy on Mark's life, $2 million death benefit, and Mark owned the policy on David's life, $2 million death benefit. This was standard practice. Then David decided to retire in 2019. As part of the retirement arrangement, Mark bought out David's stake. David's policy on Mark's life was worth approximately $800,000 in cash value. Mark's agent suggested they do a 1035 exchange, swap that policy for a single premium immediate annuity that would provide income to David in retirement. Seems reasonable, right? But here's the violation. They attempted to exchange a policy insuring Mark's life, the original policy, for an annuity contract with no life insurance element. The IRS determined this wasn't a valid 1035 exchange because the insured changed. You went from having a life insurance element to having no life insurance element. The IRS assessed $187,000 in tax liability plus penalties. David had to argue the case in tax court. He eventually settled for $156,000, but only after 2 years of litigation and $50,000 in legal fees. The lesson: if you're exchanging a life insurance policy, the new contract must also include life insurance. You can exchange a whole life policy for a universal life policy. You can exchange term insurance for permanent insurance, but you cannot exchange life insurance for an annuity without triggering a taxable event. ***, the spouse transfer complication. ***, here's another variation. Sarah owned a $2 million universal life policy on her own life. It had $340,000 in cash surrender value. She wanted to transfer ownership to her husband, James, to remove it from her taxable estate for estate planning reasons. An overzealous agent suggested they do a 1035 exchange the policy in Sarah's name for an identical policy in James's name. Violation: this failed because while the policy on Sarah's life is being replaced by a policy on Sarah's life, the ownership transfer via 1035 exchange created a technical violation under IRS Ruling 2005-9. The IRS treated it as a taxable disposition of Sarah's policy, followed by a new policy on her life in James's name, generating a $102,000 taxable event. The correct approach: simply transfer the ownership of the existing policy to James using a policy assignment. No exchange needed, no tax consequence. Counterargument worth considering. Some tax practitioners argue that strict interpretation of Rule #1 is outdated. They point to cases where the IRS has allowed flexibility when the substance of the transaction preserved the insurance relationship. The reality: courts have sided with the IRS more often than not. Playing this game is expensive. Rule #2, direct policy-to-policy transfer, or trustee-to-trustee. The second rule involves how money moves between policies. This is where technical violations happen most frequently. When you do a 1035 exchange, the cash surrender value, or proceeds, from the old policy must go directly from the old policy to the new policy. This can happen one of two ways. 1. The old insurance company sends the funds directly to the new insurance company. 2. The old insurance company sends the funds to a trustee, typically a bank or trust company, and the trustee immediately delivers those funds to the new insurance company. You cannot take possession of the funds. You cannot hold the money for even 30 days in your bank account before moving it to the new policy. The moment those funds touch your hands, you've triggered a taxable event. The entire cash surrender value becomes taxable income in that year. Case study: The Loan Trap. Richard had a $3 million variable universal life policy with $890,000 in cash surrender value. The policy had outstanding policy loans against it totaling $320,000. His agent recommended exchanging it for a more conservative fixed-indexed universal life policy. Here's where it went wrong. Richard's agent initiated the 1035 exchange, and the old policy company sent $570,000 net to Richard, $890,000 minus $320,000 in outstanding loans. Richard's agent told him, "Hold this for 15 days while we process the paperwork on the new policy, then we'll send it over." Those 15 days created a violation. The IRS ruled that Richard had constructively received the funds. Even though the intent was to complete the 1035 exchange, the gap in time meant the funds were no longer in direct transit. Richard was assessed tax on $570,000 as ordinary income plus penalties. His total tax bill, $198,400. Would the outcome be different if the funds had been held in an escrow arrangement? Possibly. But Richard's agent didn't set that up, and he's now the one paying for that negligence. The trustee alternative. Some policyholders use a bank or trust company as intermediary. The old policy company sends funds to the trustee, and the trustee immediately delivers them to the new policy company. This creates a protective buffer because the policyholders never had constructive receipt of the funds. However, and this is crucial, the trustee must be truly independent, and the transfer must be immediate. If there's any delay, any holding period, or any appearance that you directed the funds to your personal account temporarily, the IRS can challenge it. The loan complication extended. When a life insurance policy has outstanding loans, the 1035 exchange becomes more complex. The cash surrender value is reduced by the loan amount. If you want to eliminate the loan as part of the exchange, the old policy company must use the net proceeds to pay off the loan and transfer the remainder to the new policy. But here's where people get trapped. If the loan amount exceeds the cash surrender value, you could end up with a taxable gain at the time of exchange. This is called a net loss scenario, and it can surprise people who think their policy has substantial value. Example: Marcus had a policy with $400,000 cash surrender value, but $425,000 in outstanding policy loans. When he tried to exchange it, the IRS determined he had a net loss position, which created a different kind of taxable event altogether. Rule #3, substance over form, the material difference requirement. The third rule is less obvious, but increasingly enforced. The new policy must represent a meaningful exchange of insurance contracts, not a circular transaction designed primarily for tax avoidance. This is where the IRS looks at substance over form. They ask, is this a legitimate insurance exchange that makes financial sense? Or is this a contrived transaction designed solely to defer taxes? Congress designed the 1035 exchange to let people upgrade their insurance. The IRS enforces it strictly to prevent abuse. Case study: The cash value extraction scheme. Jennifer had a $2.8 million whole life policy with $1.2 million in cash surrender value. Her insurance agent suggested a 1035 exchange into a universal life policy, noting that universal life policies offer better cash value growth potential. Technically, this exchanged life insurance for life insurance. Technically, the funds went directly from the old company to the new company, so what was the problem? The IRS looked at the actual structure. The new universal life policy was designed with maximum contributions to the cash value account and minimum death benefit coverage. Effectively, Jennifer was converting what should be a life insurance policy into a tax-deferred savings vehicle. The IRS ruled that this violated the substance over form doctrine because the policy wasn't genuinely designed as life insurance. It was designed as a tax shelter. The IRS assessed $267,000 in taxes plus penalties. The key principle: if your new policy is demonstrably different in substance from the old policy, and that difference is designed to extract cash value or defer taxes artificially, the IRS can disallow the entire exchange. Asterisk asterisk, what constitutes material difference? Asterisk asterisk, a legitimate 1035 exchange typically involves one of these changes. Upgrading from term insurance to permanent insurance makes financial sense for someone seeking long-term coverage. Moving from whole life to universal life, different cost structure, may better match your needs. Consolidating multiple policies into one, administrative simplification. Switching from one carrier to another, better service, lower fees, different underwriting. Upgrading to an inflation-indexed or variable option. Protecting against inflation or. Tom had conducted 1035 exchanges over 12 years. Each time, he exchanged his current policy for a new policy with slightly higher potential cash value growth. On the surface, each individual exchange might pass IRS scrutiny, but the IRS looked at the pattern. Over 12 years, Tom had effectively turned a life insurance policy into a tax-deferred investment account. The cumulative effect, the pattern of exchanges, demonstrated that the original intent of 1035 exchanges, updating insurance, had been perverted into tax avoidance. The IRS disallowed the entire chain, assessing back taxes on all 5 exchanges, plus massive penalties and interest. Tom's bill, $487,000. Asterisk asterisk, the forgotten rule. Timely completion asterisk asterisk, there's actually a 4th rule that catches people. The new policy must be issued relatively quickly after the old policy is surrendered. If there's a significant gap, several months, for example, between when the old policy terminates and when the new policy is issued, the IRS might challenge whether this was truly an exchange or separate transactions. Best practice: the new policy should be issued within 30 days of the old policy's surrender. Anything longer creates documentation burden. Asterisk asterisk, how to protect yourself asterisk asterisk, if you're considering a 1035 exchange. 1. Get a second opinion from a tax attorney, not just your insurance agent. 2. Ensure the funds transfer directly from old company to new company or through a trustee escrow. 3. Make sure the new policy has a meaningful difference from the old policy. 4. Document your legitimate business reason for the exchange. 5. Ensure the new policy is issued within 30-45 days. 6. If loans are involved, understand